This recording we're going to focus on the area of transfer pricing, in particular Autumn 13 question 2, PERC Limited, which is a very good benchmark question looking all at transfer pricing. So there's 4 requirements here, 21 marks. It's an optional question that year, so about 42 minutes. And why I like this question is it covers the 2 main calculation type questions you can get in transfer pricing. The first type is where you're given a transfer pricing policy and you're asked to run the numbers and comment on it. And that's essentially part A and B. Part A is based on the current transfer pricing policy, calculated the budget profit and loss for each division, and watch the and here and the company as a whole, assuming both divisions are operating at full capacity. Watch the and there to both divisions and the company as a whole. And then part B is based on part A, comment on the impact it has for both divisions and the company as a whole. That's 11 marks, 11% of your paper. Given a transfer price, you're asked to run the numbers and comment, is it a good or bad transfer price? The other type calculative question that's quite popular as well is little scenario-based calculations, which is part C. So you're asked, what is the possible negotiating prices for the buyer and the seller based on different volume scenarios? And we'll come to that in due course. And then you have a nice little narrative part for 2 potential advantages for negotiated transfer prices for 4 marks. So there's 2 main areas of calculations, part A and C, and 2 areas of narrative, part B and D. It's a good benchmark question around transfer pricing in total. So if you go back up, there's actually very little information given, and that's where a lot of times students struggle with transfer pricing questions. The hardest part is to understand what's happening. So context is very important here, is who is selling to who, what price are they selling at, and what volume are they selling at. And if you understand those questions, transfer pricing becomes a bit more straightforward. Who is selling to who? What price are they selling at? And what volume has been sold? So think about those questions in the back of your head. So we're told PERC Limited is an Irish company, manufactures and sells coffee makers. It's divisional basis and it consists of 2 divisions, basic and advanced, and importantly, both are profit centres. So what that means are both management of basic and advanced are benchmarked based on how profitable they are. So they want to maximize their performance. The basic division makes a standard coffee maker and is obliged to sell to advanced, and this is the transfer price, full cost plus 15%. Any excess output that advanced does not need, basic can sell externally. So there is an external market for basic, but they first have to satisfy the internal demand. Right. Advanced purchase the standard coffee maker from basic, and after further enhancement they sell it on. So there you're given the information. So basic can sell externally at 700, or they can sell internally at full cost plus 15%. So it's actually two different prices there. There's your costs, and there's your volume. So basic, the first division, has a volume of 20,000, but advanced only need 12,000. So again, you're trying to read between the lines. That means you're told in part A, assume they operate at full capacity. So that means for basic, if you want to write it down, basic sells 8,000 to advanced at full cost plus 15%. So how many to who, we'll say where, and we'll say price. So you're just trying to get an idea. That's the way you should be laying it out. How many does basic sell? It says 8,000 to advanced. How do we know that? Because that's the capacity. It says 12,000 to advanced. Because that's the capacity of advanced. That means basic sells 8,000 externally to a third party. Because remember, basic has a capacity of 20,000. And you're told to assume it's at full capacity. The price there, 700. Because you're told there the external sales price. So the biggest thing about transfer pricing is getting it right in your head. What is happening where? And then advanced, it can only sell 12,000 because that's all it buys in to do up. Where does it sell it? It sells it externally. And the price it sells it at, you're told here, 1250. So that's your first point of call. What we have to figure out then is, what is this? This one in yellow here, full cost plus 15%, that's the transfer price. that is what Basic sells it at. So it's income to Basic, the seller, and that is what Advanced buys it at. So it's a cost to the buyer. And to calculate that, we get the full cost. Remember, we're only talking about Basic here now. So the full cost of Basic will be, put up the calculator, 250, which is your materials, plus your labor, 150, plus your variable overhead, plus your fixed overhead. So be careful there, it says full cost, so you do include the fixed overhead. If it said variable cost, you leave it out. So your full cost there is 715. That means your transfer price, we call TP, is 715, and it says a markup plus 15% times 1.15. So your transfer price there, if you want to be exact, 822.25. Now that is a lot higher than what they can sell externally at. But that they don't necessarily have to be the same thing. That transfer price is set by Perk Limited. And that's what you're going to be commenting on part B. Is this a good or bad transfer price? So you've set up now how many has been sold where has it been sold, and what the price is. So now what we're going to do is we're going to do the profit and loss calculations. Because that's what they've asked us for. They haven't asked us for detailed P&L. They want the budgeted profit and loss, and we have to do it for Basic. And we're going to do internal. We're going to do Basic external. We're going to do advanced, and we're going to do Perk. Because they do ask us for the two divisions. The reason I'm separating them out is they have two different selling prices, depending on whether they're going internal or external. And then Perk is just them added together. So what we want to know is the sales externally and the sales internally. So for Basic internally, just be careful now. Remember what we've said before. They're selling 12,000 internally at the transfer price, 822.25. So that's 9.867 million. That's income for Basic. It will be an expense for Advanced. So that should be down here. Internally. Externally, Basic is selling 8,000 at 700. It's getting 5.6 million. And Advanced then, Advanced is taking the 12,000 from Basic. It's spending its own money on them, these expenses here. The 150, the 110, etc. And it's selling them externally at 12,000 units times 1250. So it's getting 15 million of revenue in. Just make sure you're happy enough where each of those are coming from. The costs then, costs for the division. So the cost for the Basic division, we said, and you don't need to split them out, 715 times 20,000. And I'll just put a minus there, times minus 1. Now you might say, why are you doing 20,000? Well, no, we'll split it out because this one here should only be internally is 12,000 and externally is 715 times 8,000, and we'll times minus 1 as well. Well, I have the minus there, which is minus 5720. Right, so just be careful there. What I've said is, you know the full cost for each unit is 715. You've added those elements up. You don't need to show them separately. All they want is the profit or loss figure. They don't want a detailed P&L. And I've just split it in internally. That's 12,000 units. Externally, 8,000 units. So Basic's profit internally, 1.287 million. Profit externally, they actually make a loss. So profit slash, we'll put in brackets, loss. For Advanced, their cost to the division, just be careful. The full cost per unit is 150 plus 110 plus 145 plus 135. So that's the extra cost, which is 540. Minus 540 times 12,000. So what we mean by that is once they get the Basic product in from Basic, they will do an extra 540 euro worth of work to it, which will cost them 6480. What a lot of students forget to put in here is you have the cost of the internal transfer. So actually Advanced have another cost of 12,000 times 822.25. Because remember, what's revenue to the seller is a cost to the buyer. That's the key point about transfer pricing. You need to look at that. Advanced is paying 822.25. They buy it at 822.25 and they then convert it using another 540 per unit. So actually the profit or loss for Advanced is minus 1.3 million. They're actually losing a huge amount because when you think about it, they can only sell it for 1250. They have to buy it off Basic for 822 and they have to spend another 540 finishing it off to an Advanced level. So you're gone well over the 1250. 822.25 plus 540, their actual full cost per unit is about 1,300. So they're losing about €110 a unit. So it's very poor performance, but that's down to the transfer price. So the overall profit for PERC, for the company as a whole, a loss of 180 for the group. Right. So Basic here looks very profitable when you put them together, 1.1 million, but all that profit is coming from the internal transfer because they're charging such a high amount for the transfer price, and Advanced is making a huge loss because they're paying such a big price for the transfer price. But that's your part A for your 5 marks, is what's going on. Then you have to make your comments for Basic, you have to make comments for Advanced, and you have to make comments for PERC. So just be careful and read the question carefully. There's actually more marks going for the narrative than there is for the calculations. 6 marks for the narrative, 5 for the calcs. You have to be able to interpret narrative or interpret calculations at Cap 2 because that's where typically students are weak on and they lose marks. So what about this current transfer pricing policy for Basic? Well, they would be very happy. Now, I'm just doing shorthand here, but we're trying to get to a point. Why would they be very happy? They're making a huge profit, right? Selling for much dearer internally than externally. 822 versus 700. So they can achieve a much bigger price internally by selling to their sister division than they can actually get on the external market. So of course they're going to be happy here. They're making a huge profit. Right? And it probably overstates their true performance. So by using this transfer price, they're not that profitable. The only reason they're profitable is you have a hugely inflated transfer price. Right? And it also creates no incentive to control costs. Now that's an important one I want you to think about. Why does this transfer price not create any incentive to control costs? Because look at it, it's based on full cost plus 15%. So for the seller Basic, it doesn't matter what their cost is. Whatever is their cost, they're going to get that back because it's based on full cost and they're going to get an extra bit. So that suggests they have no incentive to control costs because whatever the cost of the product is, they can pass it on to Advanced. So they have no incentive there. So if you are ever setting a cost-based transfer price, it should be standard cost, not actual cost, because otherwise there's no incentive. And think about it, why that's reflective. If you look at what price they can actually get on the external market, they can only get 700. Whereas we know the full cost of a product for Basic is 715. So they're actually losing money based on the market price they can get for third parties, and it's compensated by the price that they're getting internally. So this suggests it's a very dysfunctional transfer price. Advanced would be very unhappy, paying way over market price based on the 700. What's the market price? It understates their performance because remember, Advanced is also a profit center. They're going to be very unhappy because they're going to get no bonus now, and they're going to look like they're a very poor division, right? So they're not going to be happy. They're going to be demotivated, and it's going to create conflict. Because if they find out, for example, that Basic are selling to third parties at 700, but selling to their sister division at 122 higher, that'll create a lot of conflict. So for the company overall, it's a poor transfer price. Why? Well, number one, it gives you poor performance figures. Those performance figures are artificial. Basics are artificially high, advanced are artificially low. So they're not good for making decisions. Two, no incentive to control costs. And we can see that's a problem because actually the group overall, even when you net them out, they're losing money. And the key thing here seems to be back to the cost control in basic. They can only make a unit for 715, whereas actually the external market price for this thing is only 700. So it suggests this transfer pricing having poor decisions. And the third point is it will create conflict. All you're going to do there is create conflict between the divisional managers and with the central management as well. So overall, it's not a good transfer pricing policy, creating poor performance information, no incentive to control costs, and it's creating conflict. And they're the kind of criteria you look for when you're saying, what's the objective of transfer price? It is not doing anything for anyone here. It's a very poorly set transfer price. So you see, you have plenty of points to make, but if I was in the exam now, you would use your subheadings to show the examiner clearly that I have addressed the requirement which said it needs you to comment for both divisions and the company as a whole. That's 11 marks. So you have about 2 minutes a mark as your timing in the exam. So part C then gives you another type of calculation with transfer pricing, which also came up in summer 17, if you have a look at that paper, which is smaller scenario-based questions, where you're asking if two divisions start to negotiate, instead of setting a central transfer price, which we said already in A and B is a bad one, let them negotiate with each other. And what you're asked to figure out is, calculate the transfer prices that would be acceptable to basic the seller and advance the buyer under the following scenarios and see whether it makes financial sense for them to buy or sell from each other. So it doesn't make sense to negotiate. Is there a range of possible agreement? And you can assume advanced can purchase standard coffee makers externally at a price of 625. So if we set up then for part C, you're essentially asked three scenarios. We call them scenario 1, scenario 2, and scenario 3. And what you're asked then is you're asked what's the price that the seller would want, what's the price that the buyer would want. So we call it basic, seller, and we'll call this advanced, who's the buyer. And what they want to know in each of the three scenarios, and the three scenarios are different capacity constraints for the seller. Because capacity is a big thing here in terms of is there any spare capacity that will influence the transfer price that's acceptable. What you know already from advanced perspective is they can buy all of these units externally at 625. So that will set the max price. So for the advanced, you want the max price. I'll put it under here. The max price. For the seller, you want the minimum price. What's the minimum price acceptable? What's the maximum price? In all three scenarios, 625 will be what we call the ceiling, or the max on negotiations. There is no reason why advanced would buy at a higher price than 625 because it can buy those coffee makers externally at that price. And if they want to maximize their profits, because they are profit center, you're told in the question, they wouldn't pay more than 625. So then it depends, well, what's the minimum starting price that the selling division would want? And that is driven by capacity constraints. So you're told here in scenario 1, the basic division has budgeted to produce and sell 20,000 coffee makers externally. And we know their overall capacity is 20,000. So what we write in scenario 1 is, I'll bring it over here, no spare capacity. So scenario 1 is a situation where the seller, basic, has no spare capacity. What that means is if basic has to sell to advanced and they have to sell those 12,000 units, it will displace third-party sales. Selling to advanced will displace third-party sales. So that means if basic wants to be no worse off, the minimum price they will want is 700, because that is what they can sell to third parties. So they'll want to say to be no worse off, basic will want to be compensated for what they will lose out on. they will lose out on sales to third parties. So the minimum price they will want is 700. So in this case, there will be no deal. That's your conclusion. Why? Because the buyer is only willing to pay 625. The minimum the seller would want is 700. There's what we call no range of acceptable prices. It doesn't make sense to negotiate because they will never agree. All you're doing is wasting time and you're creating conflict. So what I want you to do now is do scenario 3. We'll come back to scenario 2 in a second. Have a look at scenario 3 and think, how does this differ from scenario 1? It doesn't impact an advanced. They're still the max they want to pay is 625. But how might it impact the minimum price that Basic might want? So we'll come back to scenario 2 in a second then. So in scenario 3, Basic is only budgeting to produce and sell 8,000 coffee makers externally. So that means if they have a full capacity of 20,000, they have enough spare capacity to make the full advanced order and not impact on their external sales. So scenario 3 is the opposite. They have full spare capacity to make full advanced order and not impact third-party sales. So what you're saying there is this order would not impact, they would not lose out on sales because they weren't going to make them anyway. They only had 8,000 budgeted. So the minimum price, it's not to say they'd accept it, but the minimum negotiating price here to be no worse off would be variable cost. Why? Because they were never going to use this 12,000 of volume anyway. So if they do make the order to advanced, the incremental cost of the order would be the variable cost because the fixed cost is going to be there anyway. It'd be 250 plus 150 plus 165. So think about it. Any money that Basic gets above that is contribution. And they would have never got that anyway because they weren't using the volume. So any price here, so we'll say do a deal. Any price between 565 and 625 that's set between Basic and Advanced is a win-win. So say, for example, now you don't have to do this, but this is for tutorial. Say the price is set at 595, just as an example. Well, that means Basic are now selling each unit at €30 contribution, i.e. the price above their variable cost. So they're making €30 contribution on 12,000 units of volume that they were never going to use anyway. So they've won. They have extra money than they would have if nothing happened. Likewise for Advanced, they're buying €30 cheaper than they could buy from a third party. So they're winning as well. Now, of course, it doesn't have to be split down the middle. It could be 570, it could be 620. It just depends on the negotiating power. The key point being here, it makes sense for the two sister divisions to do a deal with each other because it's a win-win and it's a win for the group overall perk as well. The last one then, and it's a bit tricky about the examiner scenario 2, it's actually a mix of scenario 1 and scenario 3. So if you go back and look at it, in this case, the Basic has some spare capacity, but not enough for the full order. And you have to assume here, as the examiner was a bit more explicit when you look at the summer 17 question, which is very similar to this in question 1, you have to do the full order. So here they've budgeted to sell 15,000 externally. So there's 5,000 spare capacity, which is like scenario 3, but you need another 7,000 displace third-party sales, which is like scenario 1. So you have a bit of a complication here. You have 5,000 spare capacity because you're only selling 15 externally and you have 20 capacity overall. The other 7,000, be careful, that comes from making up the full advanced order. The advanced order has to be 12,000 and that's where the 5 and the 7 come from. Now, some of you might have been smart and said, well, can't you split the order? Again, the examiner, this is the first year it came up in 2013. They weren't explicit to say, oh, you don't have to split the order. When you look at a similar question that came up in summer 17, the examiner kept it a lot tighter and they said you have to do the full order or nothing. So here then the price will be 5,000 times 565 because the minimum price you'd want for those 5,000 is the variable cost plus 7,000 times 700. Because once you eat into that spare capacity, you are now displacing third-party sales. So the overall price you'd want for the full order is 7 million, and the price per unit divided by 12,000 is a 644 or 643.8. Now that was quite tricky, and it was a bit unfair that the examiner put that scenario 2, because if you did scenario 1 and 3 first, you might have come across it. But the key object here is no deal, because the overall average price that the buyer wants to pay is lower than what the minimum seller wants. So that means you're never going to have a deal, you're just going to lead in conflict. So there's only one scenario there where you'll do a deal, that's scenario 3. So that's quite important here, that's a completely different type of transfer pricing question. It's all about variable cost, it's about the opportunity cost if you have to displace third-party sales, and it's about capacity constraints. Is there spare capacity or not in the seller? And I said that was asked the first time in 2013, and it was asked again in summer 17 question 1. Go back and have a look at that. Nearly a very similar question, with students did a lot better on it because they were used to that style question. Right, 6 marks, about 12 minutes. That's all around negotiated transfer pricing. And the last one then for 4 marks, you could have done this at the very start to get marks on the board if you wanted to. 2 potential advantages with advocating a policy of negotiated transfer pricing. Right. Well, the first thing about negotiated transfer pricing is you're probably going to get a fair reflection of value in a transfer price. That if you allow the parties to negotiate between themselves, they're probably going to come to a better conclusion than if you mandate that from head office. So you may come with a better overall or fair allocation of profits with negotiated transfer price. The second thing is you probably will get more motivated divisional managers. Because if you allow them to negotiate, you are handing them back what we call divisional autonomy. Right? So by giving them back power, it'll motivate them to say, I have a bit more control. So you'll have a fair allocation of profits, most likely, assuming one division is not much bigger and has much bigger negotiating power than the other. You'll have more motivated workforce. Right? So you'll probably have a more happier workforce compared to what basic and advanced have now, where one is very happy and one is very unhappy. And you're also handing back what we call autonomy or power to the divisions. And that makes it more consistent. Because remember, and this is linking back to session 4 in Management Accounting Divisional Performance, these are treated as profit centres. Yet you're then mandating or obliging divisions to buy and sell off each other at a certain price. So you have an inconsistency there. You're saying, you're in charge of profits, we'll measure your performance on profits, but then we're dictating what you buy and sell goods at. That doesn't make sense. It's only going to lead to conflict and demotivation. So negotiating transfer prices are more consistent with a profit center structure. So you have plenty of points there about autonomy, more consistent with your organizational structure, more motivated and happy divisional managers, and you'll probably get a better reflection of the true price because the managers have better information to work off of what prices they're happy to agree with rather than being mandated a price from head office. So that was a good example of transfer pricing from autumn 2013. It's been more popular in the last couple of years, 2017, 2018, 2019. So there are plenty of exam questions to practice on around the area of transfer pricing.